Good morning. Welcome to Stock Market Today. It's Tuesday, May 5th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today where you can sign up for a free email where I get a lot of the content for this show, as well as give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So a bit of an interesting day yesterday as U.S. equities finish higher, reversing early losses. Treasuries were mixed with some curve steepening. The dollar was stronger on the euro cross, but a bit weaker against the yen. Gold was up 70 basis points and WTI crude settled up 3.1%. At the sector level, energy led the charge, followed by technology. On the loser side of the board, the airlines weighed on the industrials while financials also underperformed. And as we get to the desk this morning, S&P futures are up about 1% in Tuesday morning trading, and a little bit of a follow through from what we saw yesterday. Asian markets were higher overnight, and European markets are seeing good gains as well, though some markets still remain closed for holiday, especially in Asia. Treasuries are weaker across the curve, but the dollar is stronger against the euro and the yen. Gold is down 40 basis points. WTI crude adding up 8.5% to get us going on a Tuesday morning. And what I saw yesterday was early weakness reverse at the bottom of the support zone, right? So we've been highlighting the key support and resistance zones for right now. Remember yesterday I said what would pain the most people would probably be just to sit here and chop around sideways within this zone. And without further ado, that's what the market did yesterday. Tried to push lower on, honestly, a ridiculous rationale as far as I'm concerned, and I'll get into that a little bit later. Found the bottom end of support and then rallied. 2750 to 2800 initial support, 2485 to 2660 below that. Resistance remains in the 2950 to 3005 range. Overbought in the near term, but working off that condition. Chaikin money flow is bullish. So chop sideways here in the near term, to me, would inflict the most pain on the most people, as far as I'm concerned. It would frustrate the most people anyway. And the reason for the weakness yesterday morning, like I said, was the fact that a lot of people were pointing to the Berkshire Hathaway annual meeting and saying that Warren Buffett didn't sound upbeat. Warren Buffett didn't sound like he was buying stocks. Folks, if you sold stocks because Warren Buffett is not buying stocks, you need to check your process. And I firmly believe that. And I don't say it in a derogatory or a bad way, but it means you don't know who you are as an investor. And if you don't know who you are as an investor, what your time frame and your risk profile is, you're likely to just flail around following people, right? Follow people who are smart, follow people who give you a framework so that you can analyze and make decisions within that framework as they relate to your time frame and your risk tolerance. My guess is you don't have the same time frame and you don't have the same risk tolerance and you don't have the same access to capital as Warren Buffett. So if you're selling stocks because Warren's not buying, ask yourself, what is your process? Our market in a minute. What are we talking about in our note today to Chaikin Analytics clients? Well, turn higher after early weakness. We hit on that. Cyclical sectors are starting to show early signs of relative strength, and that's interesting to me. And we want to pay attention to it. Read my notes every Tuesday. Bearish divergence in technology does remain a concern. GBTC begins to outperform the S&P 500, and I don't see any reason why investors shouldn't be thinking about this as a potentially alternate asset class, right? We talk about equities, we talk about fixed income, we talk about commodities. Why not be looking at things like GBTC? I know I am. I'm a holder. Futures point to a higher open today, as I said. Let's take a look at the major indices now from a power bar perspective. The Dow tacked on 8 basis points yesterday, 2 to 14 bulls to bears. S&P 500 up 28 basis points yesterday. Power bar ratio actually weakened, 38 to 171 bulls to bears there. NASDAQ outperformer as it has been, 20 to 26 bulls to bears. Ratio weakened. Small cap slight outperformer yesterday as well relative to the S&P 500, 264 to 398 bulls to bears. Bonds downtick. Energy big outperformer, still 0 bulls, 18 bears. Within the energy complex, according to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. Major markets are mixed. Let's hit our stock of the day, right? Because the fan mag stocks gets a lot of play, right? They get a lot of play. For here too, I write about them every week. We talk about them. But there really is just kind of a broader group of tech and consumer tech leaders. And I think Adobe belongs in that group. ADBE, I'm highlighting it in my note today to Chaikin Analytics clients. Adobe has a bullish power gauge rating here at Chaikin Analytics in the software group, which is strong. Adobe's in a strong trend above a rising long-term trend line, which has acted as support of late. Continues to outperform the market, overbought, oversold, middle of the road, but heading towards an oversold condition while Chaikin money flow is bullish. I like Adobe. I own Adobe. In full disclosure, I own Adobe in my personal account, and I think Adobe is the type of name that you want to be paying attention to in the current market environment, right? It's a leading stock in a leading area of the market, continues to be in an uptrend, held up well through the sell-off, right? And is building a base here. I think there's a few ways that you can play it. You can wait for an oversold condition within the context of this kind of consolidation that's playing out. I think you can play a breakout through to 360. I think, there's nothing wrong with playing it on the breakout side as well. So a couple of ways to look at it. There's also nothing wrong with getting a starter position on the board right here, right now, adding to it when it's oversold and or adding to it on a breakout, right? There's no rule that says you have to buy your entire position all the time. I never buy my entire position all at once, right? And I have rules that get me in, and it's a starter position for me, generally how I look at it, a percentage of my portfolio that I'm comfortable starting with. And then as certain things happen within the mosaic, I add to the position if that is what's called for. Let's take a look at our sector tracker now. Movement in the major sectors over the last 5 days. There's energy still at the top of the list, comms and tech. I like seeing comms and tech at the top of the list. That's been leadership. But it also points to the narrowing of leadership, right? Because it is your kind of big tech and consumer tech names that are doing the majority of the heavy lifting for the market. Energy's up, right? And it's put in the top of the list, but who cares, right? Energy's 3% of the S&P 500. Literally nobody cares. Okay. Big picture portfolio construction standpoint, you might be able to get some alpha, right? But it's only 3% of the market. Who cares? Materials, discretionary staples, industrials, middle of the road, financials, REITs, healthcare, utes, lagging. We don't want to see healthcare lagging. But remember last week in my note, right, we said the name of the game was divergences. And a couple of the divergences to the upside that we said were important were negative divergences in healthcare and tech. Well, the healthcare divergence started to play out. It hasn't broken down yet, but started to play out. Tech, it's still in place, and that's the one we'll look at a little bit later on in this show. Now, our industry in focus, speaking of healthcare, is an area that we've liked a lot. I like healthcare equipment and services because it gives you a little bit of the defensive properties of healthcare, but at the same time has that growth of tech, right? Again, this is med tech. Think of it, healthcare equipment, med tech, which over the past 6 months, it's outperformed the S&P 500 by 8.71%. Power bar ratio, that was weak, 11 bulls to 16 bears, currently ranked number 9 of 21 subsectors, and it's moved down 5 slots over the past week. Cardiovascular systems, Mesa Labs and Lemaitre, CSII, MLAB, and LMAT, respectively on the ticker symbols, all have very bearish ratings. So those are the names we want to avoid within this group. But let's take a look at the group itself here, right? Nice bullish ETF power gauge rating, 11 to 16, but strong trend above call it flat to rising long-term trend line. Here's a little bit of a pullback holding above this kind of support level. I think if we're holding 80 and we get deeper into oversold conditions here, we need to be paying attention to this group that's an outperformer, right? I want to own leadership. I want to look at leadership areas of the market for bullish ideas. Take a look. Take a look at what's happening in this group. A little consolidation here around 80 might be a nice setup. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers. The refinery names, PSX, Valero, Holly Frontier, HFC, all caught upgrades yesterday at Mizuho, sending those stocks higher. Valero and HP, just oil levered names, trading higher. So thematically on the gainer side of the board, the theme is energy, right? Some sell side activity on 3 of the names, the upgrade at Mizuho on the refiners. The other two names just kind of ticking higher with the price of crude oil. So we've talked about energy for a couple of weeks now. It's caught our attention, as I've said, but fundamentals are still weak. So, and again, at 3% of the S&P, I really don't care all that much. Loser side of the board, Tyson reported earnings, and we've all been reading about what's going on with meat supplies, meat packing facilities and distribution facilities being shut down due to the coronavirus, having an impact here on Tyson, down 7.8% on the day. AAL, DAL, and Love are that airline group of stocks that were sold off as Warren Buffett announced that he was dumping his airlines. And then Whirlpool, no news there. But I'm going to show you the transports here in a little while to show you that, you know what? You could have been ahead of this. You didn't need to be in the airlines to begin with, and hopefully you weren't. But first, that bearish divergence in tech remains in play. Here's that XLK relative to SPY. This chart should look familiar. And what we're looking at here is that this high was not confirmed by momentum, made a lower high. And the RSI, even as we've worked higher, is still making a series of lower highs. That bearish divergence bothers me. It needs to be confirmed. We haven't seen a breakdown yet, right? We need to see kind of a breakdown out of this support, out of this consolidation pattern to confirm the divergence. But remember, tech is your leadership, right? Tech is where some of the big generals like Apple and Microsoft are living, right? ComService is where your other generals like Netflix and Google are living. So if these groups start to break down, right, that doesn't bode well for the market, in my opinion, right? Are the other groups big enough? You think a breakdown in tech is going to be offset by a rally in energy? Tech is 20% of the S&P 500. Energy's 3%, right? Maybe if we start to see groups like industrials rally, maybe if we start to see groups like materials rally, even there though, small, right? Are you running through these thoughts? I think it's important. If tech breaks down, who's going to do the heavy lifting? Maybe discretionary, right? But again, that would be Amazon. So just some of the thoughts that are going through my mind as I look at the composition of the market. What I will say is that, for me personally, my portfolio is skewed towards these growth names, these fan mag names that are leadership. And I'm skewed there because they're leadership, but I recognize that if they stop being leadership, that could pose trouble for the market. And, we'd have to act quickly and honor our risk management to get out. So make sure you're managing your risk as concentration becomes much more top heavy. Here's the transports, IYT, by the way, where a lot of those airlines reside. And you can see the breakdown with the market, right? Initial bouts of coronavirus. But here, using the scooter line in stock charts, you can see just a precipitous decline, a steady downtrend, right? Underperformance. This has not been a strong area of the market for some time, right? There was no need to be in this area. There was no need to be fishing around in the airlines, right? Only to be caught off guard that Warren Buffett's dumping his airlines, right? The trend was in place, below a 50-day, below a 200-day, breakdown through support, right? Underperforming. No need to be there, right? Should not have been. Yesterday should have been no news, right? And it was amazing to me because if you look, a lot of the retail investors were flocking to the airlines. Why? No need. Do your own work. Figure out what works for you in your time frame. Finally, starting to see GBTC as leadership. Here it is relative to the S&P 500. We got a topside breakout through a downtrend line as the fund rallies to the 200-day moving average. So we're similar to the market. We're stuck between the 50 and 200, but this relative strength has piqued my interest. And as I said, I am a holder. I think it's something that folks should be looking at as a different asset class. That'll wrap us up from today. Take a test drive. I'll be back tomorrow.